Welcome to the 2024 Concord Wealth Partners Halftime Report. I'm Wade Lopez, CEO of Concord Wealth Partners, and next to me is Gary Aiken, Chief Investment Officer of Concord Asset Management. Gary, welcome.
It's great to be back, Wade.
It's awesome. This is your second time, so you're a veteran, and I think you have some bragging rights. So we're going to jump right into this head first. Got a lot to talk about. First thing we're going to do is we're going to talk about your predictions from January to now. Next, we're going to talk about what we think investors should really be thinking about with the political landscape moving forward. And lastly, we're going to look into your crystal ball and see what you have predicted for us for the next 6 months. So the first thing we want to start with, Gary, is what did you get right and maybe what did you get wrong?
Well, at the beginning of the year, we said that our base case scenario was that the U.S. economy would grow at about a 2% pace and that inflation would converge on the Fed's 2% target over the course of the year. We put about a 70% probability on that, and so far, that's exactly what has come true. At the same time, we've seen unemployment start to tick up again, and we've seen some slowing down in the U.S. economy, but again, our recession call was for a low probability 20%. Finally, we also thought that inflation might return at some point during this year, and that's exactly what happened during the first quarter. Inflation came roaring back, and that's where our short duration bond portfolio call really shone out.
Gary, looking back, you were pretty adamant that we wouldn't see the rate cuts that the Fed predicted and most pundits also predicted. You were spot on with that.
Thanks, Wade. It was a little bit of a contrarian call for us, but we just didn't see the same thing the market saw at the beginning of the year. The Fed and the market had priced in about 4 rate cuts between January and July, where we are today, which would have dropped the Fed funds policy rate from 5.3% to about 4.5%. We didn't think that was going to happen for 2 basic reasons. First, we thought inflation would be stickier on the way back to the Fed's 2% target. And secondly, we just thought the U.S. economy was strong enough that rate cuts just wouldn't be necessary. When we talk about sticky inflation, one of the things that we were looking at is the rolling 3-month average core CPI. And you can see that on the chart here, that core CPI rose to about a 6.6% rate during the first quarter, but then it started to back off a little bit. And that's why we like to look also at longer term measures of inflation. So if we look at the annual inflation, that year over year number keeps coming down at a steady pace.
Yeah, and the other thing that you were pretty adamant about was that we should not be looking at yields. We should be chasing quality when it came to bonds, and you were absolutely right about that as well.
Thanks. It was another sort of contrarian call, but we thought that because of the strength of the U.S. economy, that it was more likely that interest rates would rise during the first 6 months of the year than fall. And that's exactly what happened. The chart here shows the 2-year Treasury yield and the 10-year Treasury yield, and you can see in the shaded region, that's the first 6 months of this year, that Treasury yields rose. Now, we still thought because the economy was growing that we wanted to be more exposed to corporate bonds. And corporate bonds do well when the economy does well. And that's exactly what happened as well. So we favored corporate bonds against treasuries.
Let's talk about inflation for a minute. And, the Fed talks often about core inflation, and they seem to be out of touch with headline inflation. And I don't think that's good. I think the public takes it the wrong way. But really, let's talk a little bit about why they do that. I mean, headline inflation, core inflation, explain the difference and why, if you're taking a macro look at things, you need to be focused more on core.
The Fed looks at core, and we as economists like to look at core more because those 2 things that you mentioned, the things that we see every day when we're driving our car and going to fill up our tank, or when we go to the grocery store, we see that the food prices and fuel prices are very volatile. They go up and down a lot. But ultimately, they do get filtered into the things that move a little bit slower in terms of whether their prices are going up and down. And so that's why we take food and energy out. Now, interestingly, during the first 6 months of this year, inflation in food and energy and even goods has essentially gone to zero. But where we see inflation still being really sticky is in services. And within services, the categories of housing and insurance have been the ones causing a lot of the inflation this year. And what we expect is that tight monetary policy, the Fed keeping interest rates high, will eventually have an impact on those sectors because housing and insurance are pretty interest sensitive. It hasn't happened yet, but we see signs that it's starting to happen.
With those signs, how do you see that affecting the U.S. economy?
Well, this is another area where we've tried to explain to clients that just because interest rates are high doesn't mean that U.S. consumers are going to respond immediately to that. What we like to look at on a time-to-time basis is something called the financial obligations ratio. And that's what's pictured on this chart. You can see the financial obligations ratio is the sum of what you pay for your mortgage or your rent, plus your utility bills and your car payments and your credit card payments, all those interest-sensitive expenses that we have, and we divide that by your disposable income. And that ratio ends up being about 23% pretty steadily for the past 25 years. And when we think about that, we know that businesses borrow in 5-year and 10-year loans, right? And consumers, when they go to buy a house, we use a 15-year mortgage or a 30-year mortgage. So even though interest rates have been high for a couple of years, it takes a long time for those interest costs to get embedded in the whole system. And so for that reason, consumers have been very strong, and that's led to a good economy.
And that could be one of the contributing factors to why we're continuing to see the S&P and the NASDAQ continually hitting their high water marks. But I think there's a story within that story. You want to touch base on that for a minute?
Certainly. We've seen a resurgence of tech stocks again at the first 6 months of this year, just like in the first 6 months of 2023. And tech stocks and that AI story have really led the markets higher. At the same time, we made some other calls as well. We thought emerging markets would outperform other developed market economies, and we also thought that the US dollar would be strong against other currencies. Finally, again, not to harp on it too much, but we thought interest rates were going to go up in the first 6 months, and in that case, we thought that we wanted to shy away from really interest-sensitive sectors like bonds and real estate, and you can see those were some of the worst performing sectors in the first 6 months.
Let's expand our discussion concerning, tech stocks, and most of them have climbed considerably in the last 18 months. And when you think about that, when I kind of take a back seat when I hear clients and they're asking questions about valuations, it makes you go, oh, peak to trough, trough to recovery, recovery to expansion type scenario. So are we on the verge of a potential tech bubble?
I don't think we're in a tech bubble. Certainly this chart shows the astronomical rise of tech stocks, the first line being the MSCI USA Information Technology Index, and the second one being the Philadelphia Stock Exchange Semiconductor Index, that it contains stocks like NVIDIA. And from our perspective, valuation is what matters. And when I look at the valuation of a lot of these tech stocks, what I see is they're being propelled forward not by pie in the sky, but by real earnings and real revenue growth. And those real earnings and revenue growth really make that valuation seem reasonable. At the same time, we see that their managements and their board of directors are very diligent and trustworthy. And that's something we look for in all stocks, because we want boards to be focused on doing the right thing for shareholders. But just because these tech stocks have outperformed doesn't mean there aren't success stories in other parts of the market. We've had a lot of success with healthcare companies, financials, and even consumer stocks during the last 6 months too.
Well, and we've had some success with NVIDIA. So let's stay with tech stocks and that and move on to the Magnificent Seven. How have they done for the past 6 months, and what strategic positioning or changes might you have made in the portfolios?
At the beginning of 2023 and during 2023, the financial press started to call the 7 largest stocks in the S&P 500 the Magnificent Seven. They all seemed to go up together, and they all seemed to be the only thing leading markets higher. At the end of 2023, when we were looking at portfolios, we took a look at those 7 stocks and we said, one of these things is not like the others. Tesla seemed different to us, and it was becoming just another car company in many ways. And so it had manufacturing problems. We saw that there were declining sales. There were shifting consumer preferences around EVs. Also, valuation was just really high. So we decided to sell Tesla at the beginning of the year. That isn't to say that we might not buy it at some time in the future, but at that point in time, it just seemed too expensive.
Yeah, 6 months ago, we were really worried about the political landscape. Let's take a few minutes and discuss what was actually right and what we actually got wrong.
Well, we were wrong to worry about politics as much as we were. And we were worried about government spending, climbing the wall of worry, and thinking about that. But budgets were really passed without a government shutdown. We were worried about primary season and volatility that might come out of that. But presidential primaries were over really before they began. We were worried about the Trump trials and what that would do for markets, but the trials were either postponed or even when a guilty verdict came down, markets and the polls didn't seem to care. Finally, we were worried about the Federal Reserve and all of this political stuff and whether that might affect the Federal Reserve acting during the year. But the Fed was data dependent and we think has done a great job.
That was certainly different than what we anticipated, but we learned from it. Remind us what we learned about it, and also tell us what we should be focusing on with the political landscape moving forward in the next 6 months.
While we're concerned about politics, I think the really important thing for our clients to understand is that we don't make investment decisions based upon politics. That being said, we need to know the landscape that we're about to go into. And so we need to look at the calendar just so we're aware of what's coming down the road so that we're not surprised by it. And if we look at the political calendar, we can see that today we're in the midst of the Republican National Convention. And in August, the Democrats will have their convention where they may or may not choose Joe Biden to be the nominee of their party. There almost certainly will be an October surprise. There always is before Election Day on November 5th. And of course, then next year, we'll think about January 6th when the Electoral College meets and January 20th when a new presidential administration is sworn in. What we'll be focused on as investors will be the Fed, because there's 2 Fed meetings before the election this year and 2 Fed meetings after the election before the end of the year. And whether the Fed acts before the election will be seen by some to be political. I'm hopeful, though, that the Fed will not act in a political way, but will do the best thing they think for the economy. Political fireworks are not over after July 4th, but we're focused on the Fed.
Well, I think we can both agree that whoever is elected as the president going into 2025 has an enormous uphill battle fighting U.S. deficits. And I think, make our clients feel better and listeners about what you expect, we can expect concerning how that's going to happen, because this is a situation.
One of the things that worries me as an economist and as an investor is those debts and deficits. And this chart is from the Congressional Budget Office, and it shows what is projected for the total deficit of the United States government, which is going to grow from about 6% of GDP today to about 10% of GDP by 2050. And along the way, we're going to have deficits of trillions of dollars each and every year. And as you can see from that chart, more and more of that deficit comes from interest on the debt. And so we expect the debt to grow. And we've talked to our clients, and I think our clients understand the power of compounding and how interest on interest can work for them in their investment portfolios. But for somebody who's deep in debt, interest on interest, that compounding works against you, and your credit situation gets worse and worse. And so we can see that we're already about 100% of GDP in terms of the public debt, and that's going to climb to 160% if we don't do anything about it. And what's really interesting is that even though economists seem to care about this very deeply, when you look at Pew polls, the voters just don't seem to care. They care about the economy, but debt and deficit is very low on their priority list.
Talking about debts and deficits, something that's coming up that might help that situation, I'm not very fond of, and I don't think most advisors are, but touch base on this thing called the sunset provision. And let's talk about why potentially clients might want to make hay while the sun is still shining.
The 2017 Tax Cuts and Jobs Act, euphemistically called the Trump tax cuts, contained in it a sunset provision that would make all of the individual tax cuts expire if Congress didn't act before the end of 2025. If we think that those sunset provisions are going to come into play, it's really important for our clients to talk to their Concord Wealth Partners advisor about setting up their financial situation to take advantage of that. A couple of things are really important. First, marginal tax bracket rates are going to increase. And so that means for clients who are thinking about converting their traditional IRA to a Roth IRA, this year and next year may be the time to do that. Secondly, the standard deduction is going to decrease, but high income earners and people in high tax states are going to get back the ability to deduct a lot more of those state and local taxes that they weren't able to deduct before. Finally, gift and estate tax changes are going to mean that people with large estates should go back and talk to their financial advisor to make sure that their estate tax plan reflects the most current law. I know, Wade, a lot of your clients are small business owners.
That's right.
And so small business owners are going to be faced with tax increases too, because the qualified business income deduction is going away along with accelerated depreciation schedules. What is really good though, a lot of that is bad because taxes are going up, but what is good though for our large cap stock exposure is that the corporate tax rate is unaffected by that and remains at 21%, which from a global perspective makes US companies very competitive.
One of the big issues on voters' minds has been the border crisis and the rush of immigrants coming into the United States. Let's talk about both the positive and negative effects that has and what we've seen happen so far in the labor market.
Population growth is a key determinant in whether your economy is going to grow. And so a growing population is really important. And if that growing population isn't coming from the birth rate, it needs to come from immigration. Luckily, the United States is one of those places around the world that attracts immigrants like no other. And the immigrant population in the United States has been growing over the past 3 years after the end of COVID. And you can see from this chart, it shows the foreign-born workers as a percentage of the total labor force, and that's grown from 16.5% to 18.5%. And so there's two things that we look at as economists when it comes to immigration. First is there are price impacts because new immigrants need food, they need fuel, they get government services, and a lot of them are staying in hotels, which has forced hotel prices up. But on the flip side of those price pressures going up is the fact that we were in a real labor shortage. And so the new workers coming into the US means that labor prices can moderate a little bit, and that wage price spiral that we were worried about in our inflation scenario has gone away. That's how economists think about immigration. The real question in November will be, how do people feel about immigration?
One of the things we like to discuss are how consumers feel, right? And in January, consumers weren't feeling very good. As a matter of fact, they were, feeling pessimistic. Got a lot of good information here of what's happened so far this year. So how's it going as far as consumer optimism now?
Despite the fact that the economy is in a good place and that inflation is coming down, consumers actually feel more pessimistic than they did when we met in January. This chart shows the Consumer Sentiment Index, and the University of Michigan asks a simple question. How do you feel about your prospects compared to 5 years ago? And more people feel worse off today than they did 5 years ago, and fewer people feel better off than they did 5 years ago. The last time consumers felt this bad was in 2014. And in 2014, we had a relatively unpopular Democrat incumbent, and there was a red wave election where Republicans took the House, the Senate, governorships, and state houses. But I'm in the economic prediction business, so Wade, I'm still not going to make any prediction about what's going to happen in November regarding the election.
In light of what happened this past weekend with Trump's assassination attempt, I completely understand. Let's talk about your economic outlook for the next 6 months.
Well, we think that we're even more certain that the U.S. economy is on a sound footing. And so one of the ways that we take a look at how the U.S. economy is going is by looking at what the Atlanta Fed is publishing from their models. The Atlanta Fed takes all of the incoming economic data and plugs it into a model that spits out where GDP is likely to end up and where inflation is likely to end up. And right now, with all the data, we see that inflation is about projected to be 2%, and growth is expected to be about 2%. So that's right in line with our soft landing or Goldilocks scenario. It's not too hot, it's not too cold. And so if GDP and inflation are sort of coming in right where we expected, then I think it's time to just do a double check on the labor market and the health of the U.S. consumer.
Well, you can't end with that. So where do you think you see the labor market going, and what do you see as the health of the U.S. consumer?
Well, the labor market is showing that it's coming really back into balance. Yes, we have seen the unemployment rate rise from the cycle low of 3.4% to 4.1%, where we are today. Along with that, we see that there's ample job availability from the JOLTS survey. And the quits rate is also decreasing, meaning people are really satisfied where they are, or at least don't want to jump ship. The unemployment duration is rising. That means it's taking longer for people who are unemployed to find a job. And continuing claims are rising, meaning people are staying unemployed for longer. But those numbers are right back to where they were pre-pandemic. And if we remember the pre-pandemic economy, it was still a very good economy. So if we're in a reasonably good economy with a labor market in balance, inflation sort of where the Fed wants it, the question then becomes, is the Fed and its policy rate today too restrictive?
Well, you've been pretty good at predicting for the last 12 months. So predict what you see the Fed doing at least for the next 6 months.
So we think it's finally time for the Fed to start cutting rates, and we think that they will start cutting rates in the next 6 months. One of the things that we have pointed to in the past is this chart that shows the Fed funds rate in the solid line and the core PCE inflation rate, which is the Fed's preferred measure, in the dotted line. And we've always said that when the solid line is above the dotted line, Fed policy is restrictive, and that should mean the economy should slow. That's what's happened. And so now the Fed has to think about its dual mandate of stable prices and full employment. And as the unemployment rate has started to tick up, we think that the Fed is going to shift its priorities to start thinking about unemployment again, and that means a bias towards cutting interest rates. We think interest rates are going to be cut starting sometime this fall.
So what's that going to mean for the bonds in our portfolios?
Well, typically, we might think that when interest rates on the short end decrease, interest rates at the long end might decrease along with them. We think that's not as likely to happen this time around. We think there's a lot of reasons why long-term bonds might not come down at the same pace that short-term bonds come down at. And so we think it's really important for investors to pick their battles. One of the risk scenarios that we see is, along with that debt and deficit discussion, that the markets having to absorb this huge amount of government debt may balk at that and demand higher interest rates and lower prices on bonds to buy those bonds from the government. In that case, we really want to keep our duration, our maturities short in bonds. So that's sort of where we're picking our battles.
Okay. Well, let's move into out of debt instruments and let's move into U.S. equities. What do you see for the stock market as far as U.S. equities are concerned over the next 6 months?
Absent a U.S. recession, we think that interest rate cuts are an unequivocal good for U.S. stocks. We think that AI is a real thing, the trend is continuing, and so we expect those tech stocks to continue to perform in the second half of the year. At the same time, because interest rates are coming down, that means that sectors that we weren't so fond of before are probably going to show signs of life. So we may take interest in stocks in real estate and financials and maybe even utilities where we really weren't that interested before. Finally, I want to just reiterate that yes, there's an election coming up, but we are not going to make any decisions based upon politics. All of our investment decisions have to be based upon sound economics. And so those economics of what's going up and what's going down may require us to rebalance portfolios. So we may be rebalancing around the time that certain things are going on in the election, but we're doing that because relative value suggests it's time to rebalance, not because of politics.
Okay, that's domestically, but do you still see U.S. stocks leading internationally?
We do. We think U.S. stocks are still the envy of global stock markets, and we think that U.S. stocks are still going to outperform most international markets. We think that trend will continue for a number of reasons. First is, if you think that our election is crazy, it pales in comparison to what we've seen in Mexico, in the UK, and in France. At the same time that we think interest rates in the US are likely to decline, we still think that the strength of the US economy is going to make it such that the dollar is likely to continue appreciating against other foreign currencies like the euro, the yuan, and the yen. Finally, we still see lots of opportunities in emerging markets versus other developed international markets. So we still want to be in countries and economies where they are likely to have abundant natural resources or some other connection to the US and China growth stories. We think that those places are places like Brazil, India, Australia, and although we can't invest there because there just aren't investment opportunities, Argentina also holds promise.
Sounds like a really good outlook. In fact, if I were to measure that against the current consumer sentiment, we could use words like
Optimistic.
I was going to say bold, but optimistic is very good. Based on the data and the direction that you think that you provided for the last 18 months, I'd like to use another word too, and that word is accurate. I think you've done a great job leading us since you came aboard Concord Wealth Partners, and I greatly appreciate that. Let's take a look at some of your halftime adjustments and how you're going to be tweaking that moving forward for the next 6 months.
First, we had about a 70% likelihood that our base case scenario of 2% growth and 2% inflation would play out for this year. After the first 6 months, we think we have an even stronger case for that scenario to really play out. The Fed is returning to traditional monetary policy. We think a balanced portfolio of stocks and bonds is going to do just fine. And finally, we think that falling short-term U.S. interest rates could benefit some foreign currencies, but that's not a strong conviction in that scenario. But we're increasing our probability of that base case coming true from 70% to 75%. Secondly, we're retaining our scenario where there might be a recession in the U.S. The unemployment rate is rising, the labor market is cooling, there are signs in certain sectors of the economy that things are cooling. And so it's possible, since monetary policy has been so restrictive for so long, that slow growth might become a contraction. And in that eventuality, stocks will perform pretty poorly. But we think that any recession would be short and shallow, so when stocks go down, great buying opportunity. It might also force interest rates to come down a little bit, but we think that a short duration bond portfolio is still the best scenario for risk and return. So we're not adjusting that. We're leaving it at our 20% probability. Finally, at the beginning of the year, we had this low probability scenario that inflation would return. And in the first quarter of the year, it seemed like that was playing out. That was a good thing to have in our quiver. But we are at the point now where we think inflation is going to be relatively benign. And so we've decided to replace that scenario with another one. And the scenario we're replacing it with is going back and talking about deficits and debts, talking about the bond vigilantes returning. The idea that the bond market is going to demand higher yields in the long end of the curve to buy all the debt that the government is producing. And if that happens, there may be a real disconnect in markets, and it may trigger a sell-off in bonds and maybe a corresponding sell-off in stocks. And it's something that we just want to be aware of and plan for. Again, a low probability at 5%. So just to sum it up, we think there's a 75% chance that our base case scenario of 2% growth and 2% inflation plays out. We want to be cautious and make sure that we understand that a recession is still a probability because of how restrictive the Fed has been. And we also want to be cognizant of deficits and debts potentially giving us the black swan scenario of bond vigilantes returning. But all in all, we think the next 6 months are going to be great for investors.
Well, Gary, it's time for some final thoughts, some words of wisdom, but I'd also like to end with maybe some action items that clients and listeners can take with them.
Wade, the stock market has been up a lot in the last 18 months. And so anytime we're doing any trades, we're going to be taking gains. And a lot of clients get concerned about taking gains because they don't want to pay taxes. But I think it's really important for clients to remember that no one ever went broke taking a profit. And I once knew a very successful guy who told me very, very adamantly that sell is a 4-letter word. But sometimes we have to sell stocks. Either something has changed in our original thesis for why we bought it in the first place, or maybe there's other opportunities that we find more attractive. Or finally, maybe it's just time to rebalance, that it's time to buy bonds and sell stocks. And so when we do that, we're going to be taking gains and paying taxes. But that's not the end of the story. We have strategies that help mitigate taxes. Those include asset location, which means putting certain assets in certain types of accounts. It also includes tax loss harvesting, where we would sell a stock at a loss and use that loss to offset a gain in the future. And finally, there would be tax budgeting. Some clients want to know exactly how much in capital gains they will have at the end of a year, and so we can create a tax budget for them. But all of those things, if clients are interested in mitigating taxes and our strategies around that, they should talk to their Concord Wealth Partners financial advisor, and then we'll all work together to create a strategy that works best for that client.
Absolutely. And I would like to take this opportunity to talk to our clients. Your advocacy of our firm has been absolutely amazing once again. And you know that we'll always take the time to talk to people that are important in your life, because if they're important to you, then they're important to us. Gary, it was pretty good. I got to admit, you did a really good job. I'm looking forward already to the January forecast event of 2025.
Me too. Happy investing, Wade.
Thank you, Gary. And everybody, thank you for streaming, and good night.